So when I'm talking about tools, I'm really talking about like the financial implements that people use. And there's certainly like a bunch of them. It kind of reminds me of the toolbox that I recently bought. It's like 225 pieces. When I bust that open, there's multiple trays. And if I open up one, it's all screwdrivers. And like certainly every screwdriver is a little bit different, but it's a screwdriver.
Hmm.
It's going to screw in things, right?
Yeah.
And then there might be another tray of like pliers. And like, yeah, there's like wire cutters, there's needle nose, but they're pliers. Is that you follow me with that?
Hmm.
And that's very similar with finance. There's implements that we regularly use. Like the most common ones are going to be stocks, bonds, and cash. And most people, like their entire life, when it comes to investing or saving, is just going to involve those three things. The one I always like to start with is cash. It's just the easiest to understand because everybody uses cash. But like think about what you use it for, right? If you need to go and pay your rent, you're going to use cash in your bank account to pay your rent. If you need to go and buy a coffee, you're going to take cash from your debit card maybe and buy coffee out of your pocket. And that's because that's the job that cash is designed for. It's designed to do two things really. Be available when you need it. Like the fancy term is liquidity for that, just being able to access it,
Okay.
but also being able to access it at a predictable price, right? When you need to buy a Starbucks for $5, you know that the $100 that you put in your bank account last week is still going to be there, and you're going to be able to take $5 out to do it.
Hmm.
You follow me with that?
Yes.
Yeah. So the other one that people have familiarity with, but probably a little bit less, is stocks. I always ask people, like, why do you think people buy stocks? And sometimes they try to give me like a really insightful answer, but the answer I'm looking for them to say is because they want to make money. And like that's exactly it.
Hmm.
It's people buy stocks to grow their money over a long period of time. And the way that it actually works is like a company, let's call it ABC Corporation, will divide itself into like a couple 100,000 shares and then sell them to people to boost the value of the company. That's why they call like shares of stocks all the times. When you take yourself and you divide it up 100,000 ways and you give that away, whoever you gave that to now has equity in the company. They own the company. They have equity. Sometimes you'll see stocks referred to as equities many times. And so the thought process is I think this company is going to grow over a long period of time. I want to get in on that. So I'm gonna buy a share and I'm gonna hope that I'm gonna make money over a long period of time. And so let's juxtapose that to cash for a second, right? Where cash is designed for like these immediate purchases or immediate goals, and it's very safe. Stocks is on the complete opposite end of that spectrum, where it's designed to grow over a long period of time. You're not going to buy a share of a company because you want to sell it tomorrow. You want that thing to take off over 10, 15, 20 years. But also with that growth potential, there's always going to be risk associated with that. Like anything that can go up can go down. So while there's that growth potential, there also is the risk of you could lose some money over it. That's why it doesn't make a lot of sense for an expense you might have tomorrow, but it makes a little bit more sense if it's 15, 20 years from now because you're trying to bet on a long-term approach there, basically.
Talking about it in terms of like a spectrum, you're saying cash is on one end of the spectrum and stocks is on the other end.
Yeah, what I hope you're starting to see is that we're kind of building a spectrum here where cash is going to be designed for goals and expenses that are in the near term because you know it's going to be there, it's going to be liquid, and stocks are a little bit more appropriate for long term. But then there's also that middle term, right? This is the one that people have the least familiarity with, but they actually have the most, I would argue. These are our bonds. So, what a bond represents is a contract between an investor, whoever bought the bond, and an issuer. The easiest way to think about it is think about any other time that you have got a loan. For example, maybe you got a car loan recently. So what happened was you as a person like, hey, I want that car over there, but I don't have $10,000 to go buy this car. So I go to a bank and I say, hey, will you lend me $10,000 so I can go buy this car? And maybe they say, yeah, but they're not going to give it to you for free. Nobody gives out free money. They're going to say, I'm going to give you this $10,000, but you're going to pay me back at a certain point with interest.
Mm-hmm.
And so the bank, the incentive is very clear. They want that interest payment.
Right.
They don't want just the payment every month. There's going to be $100 of principal and then $50 of interest. So they're trying to generate some current income. We just flip that on our head to understand what a bond is. A bond is when like a school board or a municipality or a government doesn't have enough money for a specific project. So what they do is they say, hey, I'm going to go to the voters or to the public and say, let me borrow some money and I'll promise to pay you back at a certain point with interest. Now, you, as the investor, are doing it the same reason why a bank loans out money, because you're trying to get that interest payment. So, again, go back to that like, what are the uses for cash, preservation, liquidity, bond, income, stocks, long term growth? So, those are kind of the three objectives with that: bonds, the interest payments. And just like a loan, too, right? If you have a really strong financial position and you're of a high credit score, you're going to be charged a lower interest rate. Same with the companies. The United States government is a very well regarded lender, so they don't pay very high interest rates. But a smaller corporation without the track record is probably going to pay a higher interest rate. Certainly for you, the risk that you have to consider is somebody might not pay what they owe you. And so there's some risk there as well, which is why it's a little bit more risky than cash, but not quite as risky as stocks, because there is still like a contractual obligation between a bondholder and an issuer. When you're talking about a stock, there is no obligation there. You bought a part of it and you fare as well as the company does. Is that making sense?
Yes.
So think about investing over a long period of time when you're taking risks. So cash is not a ton of risk in that, right? But anytime you're taking risk, think about all the things that go in with that, right? For a stock, if you buy that, that company could go out of business. So there's a lot of risk with individual stocks. Same thing with bonds, that if you have an obligation to, if you have a promise to pay some back, there's always that risk that somebody doesn't pay you back. There's interest rate risk. There's all these different things that can affect the price. So what the industry has done is they have pulled together hundreds and hundreds of different bonds and different stocks and different cash-like instruments to make something called mutual funds. And like everybody's heard of mutual funds. You've heard of mutual funds before, right? Not everybody can tell me what it is, but most people have heard of a mutual fund. And so basically what happens is there's a company like Fidelity. Everybody's heard of Fidelity, or like TD Ameritrade, right?
Yes.
They'll come together, they'll say, hey, we're going to put this stock together, this bond, this cash, hundreds and hundreds of different ones together, pool them and create our own separate investment that's going to be composed of stocks, bonds, and cash. It's going to be called something completely different, maybe, but it's going to be, at the end of the day, pools of stocks, bonds, and cash. And sometimes there's some other things, but mostly they're going to be stocks, bonds, and cash.
Okay.
And what they do is they sell that to individual investors or institutions. There's a lot of reasons why they do that, obviously to make money, but the big benefit for investors is you've now spread out that risk of one individual stock to 10, 100 individual stocks. So if one stock fails, you're going to be okay because you've actually invested in 15 or 100 different stocks. Does that make sense?
Yeah, you're spreading that risk
Have,
out.
have you heard of the word diversification? And also for professional management, you have a company that is theoretically managing it on behalf of the investors. They know what they're doing. They're trading and selling different stocks or bonds based on market conditions. That allows the individual investor to be able to participate, right? Like with larger economic transactions. Follow me still? We talked about mutual funds. And so what's really interesting about mutual funds is because it's a collection of individual stocks and bonds, the price or the value of that mutual fund has to be calculated based on like the fluctuations of all the different stocks and the bonds. All to say is that you only get one price a day for a mutual fund. So if you want to buy a mutual fund like at 8 o'clock a.m. on Saturday, you're not going to get it until Monday because that's when the market opens, and the price is actually not going to be calculated to 1 o'clock Pacific time, 4 o'clock Eastern time when the market closes, because it has to be recalculated basically. The alternative to that is something that's very similar to a mutual fund, but the price fluctuates by supply and demand, just like a regular stock. So you can buy and sell it every minute the market's open. And that's called an ETF. And so you see how we're just packaging things up, calling them something a little bit differently, but at the end of the day, they're all stocks, bonds, and cash. So stocks are for long-term growth, bonds are for current income, cash is for preservation. Stocks, the risk associated with them is that as much as it can grow, it can go down. With bonds, there is a risk that interest rates change and the price of your bond changes. There's a risk that they don't pay you back. With cash, there's also a risk. Even though the money isn't going to lose value on paper, the cost of everything else is going to go up. That's inflation. So it can lose value that way as well.
Right.
So it's just different tools that come with different benefits and different risk. And then you package them up and you have mutual funds and ETFs. Those will make up 90% of what the average everyday person actually ends up dealing with. What we've talked about in terms of goals, it's so important that we categorize them based on time horizon 1 to 3 years, 3 to 5, 5 to 10, and then beyond. And that's because there are tools designed for the time horizon.
Right.
So it kind of all comes together. Those are effectively the tools that most people are going to use. As a matter of fact, in like people's retirement accounts, most of the time they're not even allowed to use anything but mutual funds or ETFs. So that's usually a rule that comes with that. Which brings me to our next category. We just talked about the tools, but there's also what do you carry that tool in? What bag are you using? What is the toolbox? And that's where you're going to have things where you're going to hear terms like 401k, 403b, IRA, savings account. All these different things are this shells